Welcome to the Deep Dive Library, your go-to podcast for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive right into a question on, well, probably every founder's mind at some point. How do I raise capital for my startup?
It's the million-dollar question, isn't it? Or maybe the multi-million-dollar Trojan these days.
Exactly. So today, we're really going to unpack this. We want to break down what's the real difference between venture capital and angel investors.
Crucial distinction, yeah.
How can you actually pitch your startup effectively? In a way that gets investors to say yes.
The art of the pitch. Definitely need to cover that.
And is crowdfunding a realistic option? Does it actually work for funding a business idea?
Good question. It's changed a lot.
Then there's the big one. Should I bootstrap, use my own money, or go out and raise cash? And when is the right time?
The timing dilemma.
Yes. And finally, what do investors really look for? Like behind the buzzwords, what makes them pull the trigger?
Yeah, getting inside their heads a bit. Okay, let's get into it.
Let's do it. So first up, venture capital versus angel investors. Lay it out for us. What's the core difference?
Okay, so venture capital, or VC, right? Think of it as a more institutional type of funding. It's private equity, basically, but focused specifically on startups and small businesses that look like they could grow really, really big.
Okay, big potential.
Yeah.
Where does the money actually come from?
It's usually from larger pools. Investment banks, sometimes pension funds, other big financial institutions, they create these VC funds. And an interesting point is VCs often bring more than just cash. They might offer, technical expertise, management help, because they've seen this movie before, right?
Smart money, not just money.
Exactly. They raise this money from what are called limited partners, or LPs, and then their job is to invest it strategically in promising companies. They're typically looking at businesses that are maybe a bit further along, ready to really scale.
Okay, so VCs are the institutional players looking for scale-ups. What about angels then? They sound friendlier.
Sometimes they are, sometimes not. But yeah, the structure is different. Angel investors are typically individuals, wealthy individuals, investing their own money. Or sometimes it might be a small group, like an LLC or a trust they've set up.
Their own cash on the line.
Precisely. And they find deals through, all sorts of ways. Their own networks, maybe angel groups where they pool resources or deal flow, sometimes online platforms, or, founders just reach out directly.
And the terms might be different too, right?
Yeah, that's a key point. Because it's their personal capital, and maybe they have a personal interest in the space or the founder, the terms can sometimes be, let's say, more flexible than a bank loan. They often don't expect repayment unless the business really takes off. They're betting on getting a piece of the company equity and hoping it becomes valuable. Sometimes they'll want a board seat, too, to keep an eye on things.
So scale is a big difference. VCs manage huge funds. Angels invest their own money. What about motivation? Is it just about the return?
Well, return is obviously key for both. Nobody's doing this purely out of charity. But with angels, you might find a stronger personal connection. Maybe they love the product idea, or they believe strongly in that specific founder, or they just enjoy being involved early.
A bit more passion-driven sometimes.
Could be, and that can mean more flexibility in those very early, uncertain stages. Now, there's also this term accredited investor you hear with angels.
Right. What's that about?
So in the US, the SEC has rules. An accredited investor is someone who meets certain criteria, like a net worth over $1 million, excluding their house, or income over $200K for a couple of years. It basically signals they have the financial sophistication, supposedly, to handle the risks of these private investments. Not all angels have to be accredited, but it opens up more types of investment opportunities for them.
Okay, that clarifies the players quite a bit. VC for scale, angels often earlier, more personal.
Got it.
So now you know who you might want to approach. How do you actually, pitch them? How do you get them interested enough to write a check?
The pitch. Yeah, raising capital is like job number one for a CEO, and it eats up a ton of time. It's not just about having a killer idea. The pitch itself needs practice, finesse. It needs to feel organic, not like a robot reading slides.
Easier said than done, I imagine.
Totally. And one thing you hear over and over is build relationships before you need the money. Don't just show up cold asking for cash.
Like networking.
Exactly. Get warm introductions if you can. Talk to potential investors. Give them updates on your progress, even when you're not actively fundraising. Nurture those connections.
So it's a long game. How long does this whole process usually take?
It can take a while. From that first serious pitch meeting to actually having the money in the bank could be 90 days, easy. Sometimes 6 months, even 9 months or more isn't unheard of.
Wow. So you basically always need to be thinking about fundraising.
Pretty much. Kind of always be in fundraising mode mentally. And when you do get that meeting, you absolutely have to nail your numbers. Investors live and breathe metrics.
Okay, metrics. This sounds crucial. What are the absolute must-haves, the numbers you cannot afford to mess up?
Right. First off, a really basic but critical one. Bookings versus revenue. They are not the same thing.
Explain that.
Okay. Bookings are the value of the contracts you sign. It's the customer's commitment to pay you over the life of the contract. Revenue, though, is what you recognize according to accounting rules, like GAAP. Usually it's recognized as you deliver the service.
So booking is the promise, revenue is the delivery.
You got it. Don't mix them up. Then ARR per customer. Annual recurring revenue. Is that number going up over time? That shows you're successfully upselling or cross-selling to existing customers. Very important.
Growing value from each customer. Nice.
Then MRR, monthly recurring revenue, the lifeblood of many subscription businesses. But be careful how you calculate it. Don't just count one-time fees or, take one good month's bookings and multiply it by 12. Investors see through that.
You need the real recurring picture.
Exactly. And gross profit. How much profit are you making on that revenue before overhead? Be ready to explain exactly what costs you're including in your cost of goods sold.
Right. Transparency on profitability.
Yeah.
What else?
Okay. TCV versus ACV. Total contract value, the whole amount over the whole contract term, including one-time stuff. Versus annual contract value, just the value for 1 year. Know the difference.
Got it.
And LTV, lifetime value. Hugely important. But calculate it carefully. It should be the net profit you expect from a customer over their entire time with you, not just the revenue.
Net profit. Okay, that's tougher.
It is, but it's more meaningful. And the ratio of LTV to CAC, customer acquisition costs, is like the golden ratio for many investors. It tells them if your marketing spend is actually profitable long term.
Makes sense. Spend $1 to make 3, good. Spend $1 to make 50 cents, bad.
Basically, yeah. For marketplaces, no GMV, gross merchandise volume, the total value of stuff sold versus your actual revenue, which is just your take rate or fees.
Don't inflate your revenue number.
Right. And for SaaS, understand deferred revenue cash you've collected but haven't earned yet, and billings. Billings, which is revenue plus the change in deferred revenue, can actually be a better predictor of future growth than just revenue alone.
Okay, that's a bit more technical, but important for SaaS.
Definitely. Then active users. Define it clearly, daily, monthly, weekly, and focus on engagement, not just downloads. Downloads are often a vanity metric. How many people are actually using the thing?
Engagement over eyeballs.
You got it. Growth rates month on month is okay, but CMGR, compounded monthly growth rate, is often better, especially for marketplaces, because it smooths out the bumps.
CMGR. Okay. Need to look that one up, maybe.
Worth understanding. And finally, churn. Oh, churn. You need to know your monthly churn rate, how many customers you lost as a percentage of the total. Look at it by cohort, too. Do customers acquired in January stick around longer than those from March?
Cohorts are key.
Very key. And distinguish between gross churn, the total MRR you lost from departing customers, and net churn. Net churn accounts for expansion revenue from existing customers. If your net churn is negative, meaning upsells exceed losses, investors love that.
Negative net churn, the holy grail.
Pretty much. And of course, burn rate. How fast are you spending cash? Net burn revenue minus expenses is what investors focus on to see your runway, how long you can survive.
Runway is everything.
It really is. Oh, and one quick don't, avoid those cumulative charts. The ones that always go up and to the right. They don't actually show growth if the rate is slowing. Stick to period over period growth.
Good tip. Avoid the vanity charts.
Oh.
Okay, that's a lot of metrics. Heavy stuff.
So once you have these numbers crunched, how do you package it all? The pitch deck.
Yeah, the deck. Keep it short. Seriously. Under 15 slides is a good rule of thumb. Some people talk about the 30-20-10 rule. What's that?
30-point font minimum, 20 minutes max for the actual pitch. 10 slides. Wait, no, that's not it. Sorry. It's 30 minutes total meeting time, 20 minutes for pitching, 10 minutes for Q&A. Keep it concise.
Okay, 20 minutes to tell your story. What absolutely has to be in those slides?
You need the core elements. The problem. What big pain point are you solving? Be crystal clear. The solution. Your product or service. Your unique value prop. Why is it better? Your business model. How do you actually make money? Subscriptions, fees, ads, competition. Who else is out there, and why will you win? Don't pretend you have no competitors.
Investors know you do.
They do. The team. Who are you? Why are you the right people to do this? Highlight relevant experience. And finally, the ask. How much money are you raising? What will you do with it? And what milestones will you hit?
Problem, solution, model, competition, team. Ask.
Got it. Seems straightforward enough on paper.
On paper, yes. Delivering it is another story.
Right. Any tips for the actual pitch meeting itself? Standing in front of those investors? Yeah, definitely. First, get the context out quickly, like within the first 5 minutes. When were you founded? How many employees? What stage are you? How much are you raising? Just the basics so they can orient themselves.
Set the stage fast.
Exactly. Have an agenda, show you're organized, but then here's a pro move. Pause. Ask them what's most important to them. Are there any specific areas you'd like me to focus on today, or any burning questions up front?
Oh, interesting. Tailor it on the fly.
Shows you're confident and you care about their time. Then really nail the pain point. Make them feel the problem you're solving. For consumer products, it's the user need. For enterprise, it's the customer's business pain. Then demo your solution. A live demo is best if you can manage it smoothly. If not, really clear screenshots and workflow examples. Show, don't just tell.
Let them see it in action.
Yeah. When you talk market size, don't just quote some huge generic Gartner number. Talk about your specific addressable market. How many actual potential customers are there? How fast is that specific segment growing? What's the value per customer? Or if it's an existing market, how will you steal share?
Be specific about your pond.
Precisely. Address competitors head on. Explain your differentiation clearly. Briefly touch on the founders' backgrounds, just the relevant bits, and keep the financials simple in the deck. Focus on the use of funds and the milestones you'll achieve. The deep financial dive comes later in due diligence.
Preparation, clarity, knowing your audience, showing the solution. Makes sense.
And remember, investors are looking for a few key things. A great team, a big market, a compelling product. Plus, they need to understand the deal economics and how they'll have some control or influence.
Right, the deal terms matter too. Okay, let's shift gears slightly. What about crowdfunding? Platforms like Indiegogo or Kickstarter, is that a serious funding path?
It definitely can be. Crowdfunding has become a really interesting piece of the puzzle, especially for certain types of products, often physical goods, but software too sometimes.
How does it fit in?
Well, it's great for raising that initial bit of capital, maybe for your first manufacturing run or to finalize development. But maybe even more importantly, it's fantastic market validation.
Like testing the waters.
Exactly. You put your idea out there, ask people to prepay, essentially. If thousands of people back you, that's powerful proof that people actually want what you're making. It de-risks things for later, larger investors.
And you tap into a global audience, potentially.
Yeah, platforms like Indiegogo, for instance, they really try to help you through the whole process, from concept to getting it to market. They even have options like In Demand, where you can continue raising funds after your main campaign ends.
Have there been big successes?
Oh, for sure. You see examples like that nomadic travel bag raising millions, or the Hyperdrive USB hub also pulling in over $1 million ongoing. It shows significant capital can be raised this way.
So it's not just for small side projects.
Yeah, not anymore. And remember, the legal landscape changed too. The JOBS Act back in 2012 made it possible for startups to publicly advertise that they were fundraising general solicitation, it's called. That was a big shift and really helped crowdfunding take off. Platforms popped up to connect founders and backers directly.
Interesting. So it's a tool for capital and validation. Could you use it before seeking VCs?
Absolutely. It's often a great step for pre-launch validation or right after launch to build momentum before you approach angels or VCs with proof that you've got something people will actually pay for.
Okay, good to know it's a viable part of the strategy.
Yeah.
Now, this leads to another fundamental choice. Bootstrapping versus raising money.
Yeah.
Using your own cash versus taking investment. How do you decide and when?
Yeah, this is a big one. Bootstrapping is funding the whole thing yourself. Through savings, maybe credit cards, and crucially, through revenue the business itself generates. Staying lean, totally scrappy. Raising money, obviously, is bringing in those external investors we've been talking about. The general advice, especially pre-launch, is often bootstrap if you can.
Why?
Because in those really early days, your main job is figuring things out, validating the idea, finding product market fit. Raising a bunch of money too early can sometimes, paradoxically, lead you to spend it unwisely before you really know what works. It increases your burn rate on potentially unnecessary things, Stay lean, learn fast.
Don't scale your costs before you scale your validated learning.
Exactly. Think about the minimum viable product, the MVP concept. Build the simplest possible version to test your core assumptions with real users. Like that famous Dropbox example, they just made a video explaining it first. That was their MVP to gauge interest.
The video MVP.
Or a concierge MVP, where you deliver the service manually at first to learn before building complex software. The goal is learning with minimal resources. Bootstrapping forces that discipline.
But what about after launch? When you know something is working?
Right, that's when the calculation changes. Post-launch, once you have some traction, some data, you might need capital to really step on the gas. Scale up marketing, hire more developers, handle increased operational load.
Fueling the fire once it's lit.
Precisely. Funding at this stage becomes a lever to accelerate growth that's already proven to some extent. It helps you run more experiments, test marketing channels, maybe even helps establish a valuation for the company, which can be useful. It can even act as a marketing signal itself. Hey, this company got funded, they must be onto something.
So timing is everything. Don't raise too early, but don't wait too long if you have a real opportunity to accelerate.
That's the balancing act. You want to use funding strategically to grow faster or capture a market, not just to survive because your core model isn't working yet.
Okay, that makes a lot of sense. Bootstrap to learn and validate, raise to strategically scale. Which brings us back to the investors. When they're looking at a deal, maybe post-launch, what are the absolute core things they focus on? What really matters to them?
Okay, boiling it all down. Number one, almost universally, the team.
The people.
The people. Are they smart? Yes. But more than just book smarts. Do they have street smarts? Are they resilient? Fundraising is hard. Building a startup is brutal. Can they handle the punches? Can they communicate well? Can they execute? Do they have a high tolerance for uncertainty? And can they learn from mistakes? Investors are betting on the jockeys as much, or maybe even more, than the horse.
They want founders they believe can figure it out.
And founders who they believe know their space better than the investor does. You want the investor to feel like they're backing an expert.
Okay, team is number one. What's next?
Market. The opportunity has to be big. VCs especially need potential for huge returns to make their fund economics work. Is it a large, growing market? Can this company realistically capture a significant piece of it and become very valuable?
No point having a great team if the market is tiny.
Exactly. Then number three is the product or solution. Does it actually solve a real significant pain point? Is the value proposition clear? Is there proof it works and that customers want it? That MVP validation we talked about is crucial here. And how does it stack up against competitors? If you can show you're already winning on key metrics, better margins, faster growth, higher engagement, that's obviously very compelling.
Team, market, product.
The Holy Trinity.
Pretty much the core, but then you layer on traction and metrics. All those numbers we discussed earlier, investors dig into those to understand the health and momentum of the business. Engagement, retention, LTV, .SAC, burn rate. The proof is in the numbers.
Show, don't just tell, with data.
Absolutely.
Yeah.
Then especially for professional angels and VCs, they need to see a potential exit strategy. How will they get their money back? Multiplied. Acquisition by a bigger company, an IPO down the line. They need to see a path to liquidity.
They aren't investing just to get dividends. Rarely, especially not in early stage tech. They need that big exit potential. And related to that is valuation. What's the company worth now? What will it be worth? Getting the valuation right is key for both sides. Fundraising helped establish that.
And is there anything else beyond these core factors?
Yeah, there's also the softer element of fit. Does the investor feel they can actually help this company beyond just writing a check? Do they have relevant experience or network connections? Do they click with the founders? It's why building relationships early is good. You can suss out that fit. And founders should pre-qualify investors too, make sure they actually invest in your sector at your stage in the amounts you need. Don't waste time pitching the wrong people.
Team, market, product, traction, exit, valuation, and fit. That's a pretty comprehensive checklist.
It covers the main things investors are weighing up. Yeah, that's a complex decision with a lot riding on it for them.
Absolutely. Well, we have covered a ton of ground today. This has been incredibly insightful.
Yeah, it's a big topic. We went through VCs versus angels, the whole pitching process, the metrics, the deck, the delivery, then looked at crowdfunding as an option, wrestled with bootstrapping versus raising and the timing, and finally really tried to pin down what investors are fundamentally looking for.
It really feels like understanding these pieces is the absolute foundation for anyone looking to raise capital.
Couldn't agree more. Getting your head around this landscape is step one on that whole fundraising journey.
If you found value here but haven't subscribed yet, why wait? Every subscriber fuels this channel to keep delivering the real, game-changing content you need. Hit like, drop a comment, and subscribe. And now, W, don't miss out on the next episode that could change everything for you.